So for the next part, we will discuss substantive test procedures. So in our previous topics, we have covered risk assessment procedures, particularly when we discuss planning and audit of financial statements, as well as test of controls. Now, when we discuss study and evaluation of internal controls. So this time, we will go to substantive test procedures whose objective when we perform them would be for us auditor to detect material misstatements at the assertion level. So substantive test procedures would be one of our responses to assess risk of material misstatement found at the assertion level. So meaning to say those contained in the account balances, in the classes of transaction, in the presentation and disclosures, in the financial statements of our clients. Now let us discuss the different types of substantive test procedures. So again, this will be the main source of our evidence. So to support our opinion whether the financial statements of our clients are fairly stated or not. So first, we have substantive analytical procedures or substantive analytical review. So as a substantive test, the purpose of our analytical procedures here would be to detect the material misstatements found on the financial statements of our clients. However, analytical procedures by nature would be considered less reliable compared to test of details. So because remember, analytical procedures are limited, for example, to test of reasonableness. So therefore, if there will be difference between the amount that we expect versus the actual amount recorded by the client, so that is not considered concluding evidence that there were misstatements in the account. We will still need to perform further investigation whenever there are significant difference or deviation from the amount that we have expected. And because of the less reliable nature of analytical procedures, we normally perform it when the risk of material misstatements are lower. So it follows that analytical procedures, as substantive test, is not always required in every audit. So it's only warranted by circumstances. So we only perform it if we expect that the risk of material misstatements would be considered lower. So in addition, we normally perform analytical procedures to class of transactions such as income statement accounts. So because remember in our discussion that it's easier to predict the trends or the movements in income statement accounts or transactional accounts compared to balance sheet accounts. So that is why we normally use analytical procedures when we audit sales transactions, interest income, interest expense, so foreign exchange gains or losses. So usually applied to income statement accounts. No, but of course not limited only to those accounts as well. So we normally use this to test the reasonableness of the amount recorded by the client. So on the other hand, we have substantive test of details or test of details, so which is always required in every audit. So this will be the main source of our evidence. So with respect to determining whether the financial statements accounts are fairly stated. And we have the different types of substantive test of details. We have a substantive test of details of balances or a test of details of balances, substantive test of details of transactions or test of details of transactions, and substantive test of details of presentation and disclosures. Although in most references, only the test of details of balances and test of details of transactions are usually given, no? Because our procedures with respect to presentation and disclosures are often incorporated already in the test of details of balances and test of details of transactions. So meaning to say, usually we don't have separate procedures anymore with respect to testing, presentation, and disclosures because they are already part of our procedures in testing the details of balances and transactions of the accounts, classes of transactions, including disclosures. So again, test of details are always required in every audit. So this will be our main support in whatever opinion we will issue on the financial statements of our clients. So what would normally matter, or what would normally be varying, would be the extent of procedures that we will be performing in the test of details. So because the result of our risk assessment now would affect the level or amount of test of details that we will perform. Like for example, if we expect to rely on the internal controls of the client, we have tested the operating effectiveness of the controls, and we have concluded that the internal controls of the client are operating effectively. Then that means we can perform less substantive test. Okay, but that doesn't mean that we will omit substantive test altogether. So because this is always required, we will still perform some level of substantive test, but to the lower extent if we can rely on the controls of the client, or if we assess that the risk of material misstatements are lower. Okay. However, if for example we conclude that we cannot rely on the internal controls of the client, or we have tested the controls of the client and found out that the controls are not operating effectively, then we have to perform more extensive substantive tests. So the nature of the account or the volume of transactions can also affect our decision whether to rely more on a specific type of substantive test. Like for example, if let's say the transaction involved to be audited would be less risky, like let's say payroll expense, the controls are good, so lower risk of material misstatement, so we can to decide to use substantive analytical procedures, or we will rely more on substantive analytical procedures and less on test of details. So if ever we will perform a test of details, it would not be that much compared if, for example, the risk of material misstatement would be higher to that particular transaction. Okay? Or let's say, for example, between high turnover and low turnover account. So let's say high turnover account like cash or receivables or inventory. So it would be tedious if we will obtain support from test of transactions. So normally we will rely more on test of details of balances to verify the ending balance of cash or receivables. Okay? So but if it's a low turnover account, like let's say property, plant, and equipment, so we can rely more on test of details of transactions, for example, test of additions and disposals. So compared to test of details of balances, so given that we have already audited, or we have an audited beginning balance of that particular account. So the nature of the account, the volume of transactions can also affect our decision. So on what type of substantive procedures to perform. And also the objective, no, or the assertion that we are validating. Like for example, if we are validating cut-off, then most likely we will perform test of transactions or test of details of transaction in validating that particular audit objective. So ultimately, it will depend on our professional judgment as auditors on what procedure to select, or we deem it necessary to perform a particular audit procedure. So in practice, usually the managers or the senior member of the audit team will prepare an audit program to determine which audit procedures will be performed by the audit team in verifying or validating a certain account, class of transaction, or presentation and disclosures in the financial statements of our clients. So here are some specific examples of substantive test of procedures. So let's start with the test of details of balances. So usually one of the first thing that we do as auditors is that we tie up the amount in the financial statements with the general ledger and the subsidiary ledger of the client. So the general ledger, normally this is the amount that appears in the trial balance. Now, trial balance provided by the client, and the subsidiary ledger is the more detailed record kept by the client supporting the amount appearing in the trial balance of our client. So usually these records can be generated from the accounting system being used by the client. So let's say we are auditing cash. So the cash and cash equivalents appearing in the financial statements of the client so can be traced to the trial balance. So in the trial balance, that cash and cash equivalents may be made by a number of accounts. So like there will be a different account for cash on hand, for cash in bank. So usually if the client maintains a separate cash in bank account, it's possible that they will have different accounts and different subsidiary records. So we will compare whether the amount in the financial statements tie up with the total amount of individual accounts in the trial balance, so which serves the general ledger, and the details comprising those accounts also tally when we compare it with the subsidiary ledger. So if there are discrepancies or if there are differences, so we have to investigate those differences. So they most likely would result to material misstatements. So if there are differences between those records. Okay, and some of the procedures that we perform in audit of cash, for example, for cash in bank, usually our starting point is to review the bank reconciliation of the client. So confirm the cash balances with the financial institution. So we can also perform proof of cash and cash count procedures for the cash on hand. So especially if it's material or we suspect that there is a high risk of material misstatement on cash of the client, especially if their internal controls over cash transactions are weak. Okay? Then for transactions, so transactions involved in the cash account of the client would normally be the cash receipts and cash disbursement. So we can test those cash receipts and disbursement. So meaning to say we can verify with the source document whether the amount recorded in the accounting records of the client, like cash receipts journal and cash disbursement journal, so reflect the correct amount, the correct date, the correct details. So we can also perform cash transactions cut-off test, so to determine whether the transactions were recorded under the correct accounting period. Now, some procedures may serve as both test of details of balances and test of details of transactions, so like proof of cash. So in proof of cash, we are not only validating the balances of the cash account of our client, but as well as receipts and disbursement. Okay? And for substantive analytical procedures, some examples include the test of reasonableness. So let's say we test the reasonableness of the interest income. So we test the reasonableness of foreign exchange gains and losses for cash accounts that are uh, denominated in a foreign currency. So these are some of the procedures that we can find in audit of cash, for example, of the client's financial statements. So next, when do we perform substantive test procedures? So ideally, we perform substantive test procedures at or near year-end. So we call it year-end procedures. Okay? So this is normally the default, especially if the risk of material misstatement is higher for that account. So let's say that is a significant account or material transaction, then we normally audit or perform procedures, substantive test procedures at or near year-end. So procedures performed at or near year-end have high reliability. So because they reflect, for example, the actual balance as of the date that we want to express opinion to, so which is the December 31 balances of the client. However, not all procedures can only be performed at year-end. So sometimes there are procedures that can be performed before year-end. So if the procedures are performed before year-end, normally we call that interim procedures. However, this is warranted by circumstances. So this is conditional. So normally we are allowed to perform interim procedures if the risk of material misstatement is lower. Now, for the reason that interim procedures are normally less reliable as compared to year-end procedures. So there are conditions that should be taken into consideration before we perform interim procedures. Okay, so example. So example, we are auditing inventory. So if we are auditing inventory, so for year-end testing, so we will observe the inventory count at year-end or near year-end and perform audit procedures on inventory like test counts. So test counts, we will select several items from the accounting records of the client like the inventory list, okay, and vouch it to specific items in the warehouse of the client, or we can also select specific items from the warehouse of the client and trace it back to the accounting record of the client. So those procedures when performed on year end are considered highly reliable. Okay? So on the other hand, if we perform interim testing, then that means we will observe the inventory count procedures of the client and perform audit procedures like test count at an interim date. So let's say 1 month before the year end. However, what we are auditing would be the year end. So therefore, we have to perform procedures on the intervening transactions, so between the count date and the year end. Like for example, the sales and purchases transaction from the date of the account to year end. So that is why before we can decide to use interim testing, so we have to make sure that the controls of the client over sales and over purchases are reliable. So otherwise, we cannot use interim testing in case the controls of the client over its transactions related to sales and purchases are not reliable. So because for the ending balance, our confidence will, or our assurance now will come from the amount that we have audited on the interim date, so plus the purchases minus the sales at cost to arrive at the ending inventory at year end. Okay? Now, there will be a separate discussion of the specific substantive test for each account, but it will be very summarized in nature. So the more detailed discussion will be covered in a separate course, which is Auditing and Assurance Principles, Concepts, and Application. So wherein there will be a very detailed discussion of each procedure in each transaction cycle, which will cover all the accounts in the financial statements of our clients.